Stocks form a cornerstone of long-term investment strategies, historically generating wealth and helping investors reach their financial objectives. Yet, investors often concentrate on large company stocks, overlooking other market segments that could enhance portfolio diversification. Market coverage typically centers on the S&P 500 and the Dow Jones Industrial Average. The S&P 500 tracks 500 of the largest U.S. companies by market capitalization, while the Dow includes just 30 established firms. Both focus exclusively on America's biggest corporations, which can provide insight into broader economic trends, but may miss valuable investment opportunities elsewhere. This concentration becomes particularly relevant when a few mega-cap companies, including the Magnificent Seven, dominate market movements. Small-cap stocks in international markets present compelling alternatives that offer distinct characteristics and diversification benefits, especially during periods of market volatility. Small-cap companies, with market values typically between hundreds of millions and a few billion dollars, contrast sharply with their larger counterparts valued in the tens or hundreds of billions. The Russell 2000 Index has delivered a 5% annualized return over the past decade versus 10.5% for the S&P 500. This gap reflects increased market concentration in technology and AI sectors where small caps have limited exposure. Current valuations suggest potential opportunities. Small cap stocks trade at a price-to-earnings ratio below their historical averages, with the Russell 2000's price-to-book value near 0.8 times compared to its 1.2 times historical average. Meanwhile, S&P 500 valuation metrics remain elevated. Additionally, small caps' greater reliance on floating rate debt makes them sensitive to interest rate changes, potentially benefiting from future Fed rate cuts. The MSCI EAFE index gained approximately 17.5% year to date, while the MSCI Emerging Market Index rose 10%. Valuation differences remain substantial, with international markets trading at more attractive price-to-earnings ratios than the S&P 500. Currency fluctuations add another dimension, as the weaker dollar has created favorable conditions for U.S. investors, boosting returns when foreign assets are converted back to dollars. Maintaining exposure to small cap and international stocks helps create a more balanced portfolio, particularly after large cap concentration driven by a handful of mega cap companies. This doesn't diminish the importance of U.S. large caps or suggest dramatic portfolio changes, but rather emphasizes maintaining appropriate asset allocation across all investment types. The bottom line, while major indices remain important benchmarks, investors benefit from diversification across smaller companies and international markets. Maintaining well-balanced portfolios for the long term remains the most effective path to financial success.